Welcome back, everybody, to the Retire with Jeremy podcast, where we talk about everything in your retirement. Today's topic is all about emergency funds. And Jeremy's going to give us some really helpful tips on when you should start, where you should put it, and how you should structure it. So, Jeremy, the first question I have, can you ever have enough money in an emergency fund?
Man, absolutely. There is such a thing as enough, and there's actually such a thing as too much when it comes to your emergency fund. I've actually come across this, both types, a lot in the past year. And so let's kind of dig in a little bit. Let's talk about the targets. The basic idea for an emergency fund is to be able to kind of hit, typically 3 to 6 months of expenses. And that's for most people's households. Now, there's some other situations where you might want 6 or 12 months. That's the target. So what happens though is we sometimes get into safety and stagnation. We get into the idea that I need to have that emergency fund because we're trained from the beginning to start saving and doing the basics. And that is awesome. We love that. But it can go to a point where that's all you do, and then you have a thing called opportunity cost that comes in. Fancy word, but basically, you might should be doing other things. There's another opportunity for your money, like, for example, paying down high interest debt. You might have some debt out there that needs to be eliminated. You might need some other goals funded, college, retirement, hello, and business opportunities. And then you might be ought to be diversifying out into other things, other investments, for example. And then the last thing that I think people overlook a lot is giving. You ought to be giving your money away because that's where a lot of joy in life's going to happen is when you see it put into motion. So yes, money can be too big in the wrong spaces. When your emergency fund may be more than a year of expenses, that's too big. So if you're still adding to that fund, even though nothing about your risk profile has really changed, it's too big.
It's probably not as productive to just hoard all that money on just your regular checking account. So is there a specific place? Are we putting this in a money market account, a high yield savings account?
I recommend this. So maybe my first $1,000, or you can pick a number, but let's say it's $1,000. I might keep that in a savings account that's adjacent to or right next to my checking account, because if you've ever written a bad check or had an overdraw, there's a fee, right? They
Mhm.
charge you a handsome fee for that. I don't even know what it is, because I've been following this advice, and because if I ever overdraw my account, and it happens, I have a buffer. I have this other fund that I tell the bank, if you ever overdraw, go pull it from this savings account, and they can link those things up for you on the back end so that you never have an overdraw. That's number one, is really keep that money close at hand. But then after that, for your kind of getting onto the 3 to 6 months of expenses track, that's where we're going to use a powerful tool. We want to see a money market fund in place for that kind of stuff because it earns interest, and we're trying to really fight the inflation monster. Inflation is coming to slowly drain or slowly eat away the power of that dollar that's in there. So we have to fight that with putting interest back into it. It won't be a lot, but it'll be enough to just keep inflation at bay.
Also,
So
kind of what I'm hearing is keeping it as simple as possible. So, kind of having it right next to your checking account. You're not doing anything fancy with having to, make your own Schwab account or make another Robinhood account. It's right in your bank account or in your kind of banking app, whatever you use, and just start putting away your 3 to 6 months. And would you say that's the hardest step about building your emergency fund is getting that paycheck and having to say, okay, I'm putting X amount away and I can look at it, but I can't touch it.
it is. I think there's so I want to address that, like, if I'm on the other end of the spectrum, I don't have too much, I have nothing. Starting is the hardest part. But once you start seeing a little bit of traction, that first $100, and maybe that's going to take weeks to do that, getting that first $100, the first $500, and starting to see the balance grow. Saving money is hard. It's
Mhm.
psychologically hard because it feels like it doesn't do anything for a long time. This is a classic example of beginning with the end in mind. I want to be okay when an emergency hits. You've got to hold that focus all the time. And then once it's done, you can kind of sit back and relax, but because you're ready.
Thank you so much, Jeremy. Another excellent episode. The hardest part is starting. Start putting away some money. Cap yourself around 3 to 6 months, enough to hedge yourself against some emergencies. Don't make it complicated. High yield savings account, put it right next to your checking account. Thank you so much for watching another episode of the Retire with Jeremy podcast. If you have any questions, leave them in the comments below, and maybe Jeremy will answer them in the next video. If you want to book a meeting, there's some links in the description. Also to our website, we have a lot more resources there. Thank you so much for watching. Have a great day.